opening by the Commissioner and the Acting General Manager last month, and this month we are now getting into the meat of the issue where we're having technical presentations. Today, on NASA benefits, as I said, by Mr. Cosmas Chikwa, who is the Research and Schemes Planning Manager. And we're also going to have a presentation on unpacking the private occupation pension industry from Mr. Munjoma, who is the Director of Pensions at IPEC. So that is it. It's going to be quite a busy day, and as usual, we call upon for your maximum participation in terms of questions, in terms of contributions, and so just give us a few minutes, and we'll be ready to roll. Thank you. Hello, I'm back again, colleagues. I think for the sake of progress, we're going to switch the presentations around. We'll start with the presentation by the Director of Pensions at IPEC, Mr. Munjoma, who is going to speak on unpacking the private occupation pension industry. So I'll hand over to him so that he can begin his presentation. And during the course of his presentation, jot your questions down. We're going to have a question and answer session later on after the presentation. So please keep your questions, or you can also post them in the chat box on this platform. Thank you very much, Mr. Munjoma. Over to you, and welcome, sir.
Thank you, Director of Program. Good morning to you all.
Good morning, sir.
Thank you. Confirm you can see my slides.
Confirmed.
Yes, they are clear, sir.
Thank you very much. Thank you for this opportunity to share developments in the private occupational pension space. Cuthbert Munjoma is my name, Director responsible for pension supervision at IPEC. In terms of our presentation outline, I will just introduce the subject of regulation and supervision, why we regulate, types of supervision that we do, including the supervisory tools that we use. I'll share the architecture of the pensions industry as of 31 March 2023. I'll again share different types of service providers to private occupational pension schemes, their respective roles, as well as our assessment of whether there are any areas for improvement. Then I'll give some concluding remarks. So just to get the ball rolling, it's important that we appreciate the meaning of regulation and supervision. Most often, if you follow media, debates, especially regarding, regulation, you can actually pick that there's a misunderstanding of what the regulation entails. So regulation essentially means you are setting rules, regulations, systems that would have to be adhered to. And generally that is done through a legal instrument. Then supervision essentially means enforcing the rules, the regulations, the laws, the frameworks that would have been set by the regulator. So those terms are interchangeable. Generally, most regulators are also supervisors, but in other markets, you can have an entity which is solely responsible for setting the rules, especially ministries of finance used to assume that responsibility. Then you have someone just doing the supervision. In our cases, IPEC, we have a role in setting the rules, that is the directives that are enforceable at law, the frameworks, the circulars, and we also draft the regulations, which would have to be gazetted by the minister. They are approved by the minister, then gazetted. We also have a role to play, especially in terms of the enactment of the primary statutes. We can identify areas for improvement. We make recommendations to the Minister of Finance, who then instructs the Attorney General's office to ensure that there's a drafting of a law, either to amend an existing law or to repeal. Then supervision, you are simply enforcing. So I thought those terms are important to note if you really want to be technical about the regulation and supervision. Otherwise, generally, they are used interchangeably, though they mean differently. So why do we regulate? Generally, literature is very clear that markets do fail, markets are imperfect. Traditionally, regulation used to be self-regulation, where entities would just self-regulate. They can form an association, which were regarded to as self-regulatory organizations. Then through market pressure, they can actually, approach one player to say the way you are doing business is not proper, it's not ethical, it's not professional. And through that market pressure, an entity can actually do the right thing. But it was observed that generally markets are not perfect, markets do fail. You'd need an entity which is independent just to ensure that things are being done well and in the interest of all stakeholders. There's moral hazard again. We are talking of an industry which is cash rich, endowed with billions of dollars, and entrusting this to be it individuals or certain institutions without checks and balances, then it can actually present a big risk. So again, the intention of regulating is to ensure that we deal with potential moral hazard, the issue of asymmetry of information. We are all contributing to pensions as journalists. And without disclosure in terms of how the funds are performing, you may be surprised once you reach retirement age, there's nothing. So regulation is meant to ensure that there's information available to all important stakeholders, the nature of disclosures that are required, the frequency, among other things. Regulation again is meant to ensure that we regulate competition so that there's fair practice. Whilst generally there are competition regulators in most markets, to some extent we also overlook the issue of competition, though we have the Competition and Tariff Commission. Then the protection of scheme members. This is actually very clear in our legislation that we have a role to protect pension scheme members and the policyholders. Allow me to move to the issue of types of regulation that we do in the supervision. We do what we call prudential supervision. Prudential supervision is generally aimed at assessing the financial health of a pension fund, financial health of an insurance company, or a service provider, such as an administrator or an intermediary, be it broker, among others. So by financial health, we have the frameworks that we use. We use what we call a Caramels framework is for insurance. For pensions, we use a Saramels framework. Basically, you are assessing, things like soundness, you are assessing asset quality, you are assessing reinsurance arrangement, you are assessing actuarial issues, we are assessing governance, earnings and profitability of entities, liquidity, and we also do what we call scenario testing. So that's mouthful, but in layman terms, all you are looking at is the financial health of a pension fund. And there are various aspects that we consider at a technical level. Then we do have what we call market conduct regulation. This is emerging. Traditionally, regulation has been focusing on financial health of an entity. But until recently, over the last 10 years, regulators have introduced what we call market conduct regulation. This is meant to ensure that the members are protected. I hear some feedback, director of program. I take it I'm not being required to stop.
No, you can continue, sir.
Okay, fine. Thank you. So we have what we call market conduct regulation. This is meant to ensure fair protection of pension scheme members and policyholders. You can have an entity which is healthy in financial terms, but mistreating its customers. Hence, there's now a focus to do with the market conduct regulation, and in IPEC, we have teams that are responsible for prudential, which is the financial health of entities, then teams that are also seized with ensuring that the customers are protected, the customer concerns are noted and addressed. Then the third leg of supervision is the AML safety supervision. And the AML safety stands for anti-money laundering, combating financing of terrorism. The primary regulator in Zimbabwe is the Financial Intelligence Unit. But us as IPEC, among other regulators, we are known as competent supervisory authorities. We have delegated responsibility in terms of the Money Laundering Process of Crime Act to supervise our sector for the purpose of ensuring that the sector is not abused for the purpose of money laundering as well as terrorism financing. So this is another responsibility that we have in terms of regulation and supervision. So in terms of tools, where do we derive our powers? Everything that we do has to be in line with the legislation. Our actions have to be backed by law. So we are guided by the primary statutes, which in our case for pensions is the Pensions and Provident Funds Act. This is a new act enacted effective 2nd of September 2022. It repealed an old act which was there in an effort to enhance supervision. We have regulations that are issued pursuant to a primary act. Right now, we have regulations that are before the Attorney General's office that are meant to support the new act. They will replace the old regulations which are in place. We have powers to issue what we call directives, circulars, guidelines. This is more of a third level of legislation where we can actually, they are enforceable at law. We do inspections as part of monitoring the financial health of entities, monitoring the fair treatment of customers, or monitoring aspects to do with anti-money laundering. Inspections can be on-site or they can be off-site. Off-site, we get returns on a quarterly basis. We get annual returns. We analyze them. These are financial statements. These are actual valuation reports, investment management reports, and the various disclosures that we request. We analyze this from an investment analysis perspective, actuarial analysis, financial analysis. We have, multiple skills that assess these reports from a different angle. Then we assess areas for intervention. So those are offsite inspections. Should we notice anything that warrants us to go to the entity, we do what we call on-site inspections, and we have procedures for doing so, and we are conducting these inspections. Then we can issue penalties or impose fines for any breaches. Then we can also do investigations, which may result even in prosecution of those that would have misused public funds. So in terms of the pensions architecture in Zimbabwe, we have a three-pillar pension system. We have the mandatory NSSA. We are working closely with NSSA because we are in the same space. We are all statutory entities, hence our collaboration in this regard. We have the civil service pension scheme, which used to be a pay-as-you-go. It's transforming into a funded scheme. And I understand that there are deliberations even to review the State Service Pension Act. There's a bill in place. Then we have voluntary occupational skills, which are under the regulatory purview of IPEC. So it's important to note the different types of pension schemes. We have generally a pension fund. We have pension funds, provident funds, preservation funds, retirement annuity funds. And the pension funds, generally, these were employer-sponsored group funds. An employer, as a way of attracting employees and looking after employees after retirement, would make an initiative to establish a fund. But of late, we are now also seeing those that are not formally employed. They can now also group together. They can also register a fund. But the traditional model, which has been there of employer-sponsored, the employer would establish the fund, form a board of the fund, which I will talk to later during the part of my presentation. They have rules of how they should run the fund and the benefits that are paid from there. Generally, as you get retirement age, it's about 1/3. You get it as a lump sum. The other 2/3, you get it as an annuity until death. Then we have what we call provident funds. These used to be many a long time ago. A provident fund, you just contribute into a fund. On a retirement, you get a full lump sum, everything. Then you decide what you want to do with it. So this is a trend phased out globally, because once someone get those monies, they can actually be spent overnight, and pensioners get into poverty. But we still have a few remaining in Zimbabwe. Then preservation funds. These are individual retirement funds. Suppose as a journalist, you are working, you're contributing to a fund. You decide, say, to leave the country, go to the diaspora, or you decide to go to get into farming. Those amounts which you would have contributed, they can be preserved until you retire. And they are preserved in what we call a preservation fund. So it can be a pension preservation fund or a provident preservation fund. Then we have what we call retirement annuities. Individuals can set aside own funds for retirement, and generally these are offered by life companies. Suppose I get out of employment for any reason, it could be retrenchment, it could be voluntary. I can actually have my funds preserved such that on retirement I can get an annuity. So there are also different types of funds, say by benefit type. We have what we call defined benefit and defined contribution. Defined benefit, you know the benefit in advance. It's calculated based on length of service, final average salary. It's actually non-upfront. And generally, it's a proportion of a salary that you were earning is just before retirement. Under this fund, should the fund not perform in terms of investments, the employer guarantees that the employer will still meet the obligation to pay you a certain proportion of your salary when you retired. These are actually phasing out globally, and even in Zimbabwe. Most funds converted from DB to DC in the late 90s, 2000s. Right now, we only have a few, about 41 defined benefit pension funds, some of which are also in the process of converting to defined contribution. Why do they convert? Generally, it's affordability issues. The employers would say, I'm struggling, I cannot afford to guarantee that I will pay all my workers after they retire, say 70% of their salary just before retirement. So there are issues to do with affordability, but from a member perspective, most members generally would prefer something which is defined upfront. Then we have defined contribution schemes. That's the majority globally, and in Zimbabwe, in Zim, out of 977 funds, if you list 41, over 930 something are defined contribution schemes. What is defined is the contribution rate for the employer, for the employee, then the members bear investment risk. So the funds are actually invested in different asset classes. Should those funds be misappropriated for any reason, the members will suffer. Should the assets also lose value for whatever reason, it could be macroeconomic factors, the members would suffer. So from a member perspective, if the assets are not ring-fenced, they are not protected, there's no proper governance, they consider these schemes as a risk, but it doesn't always follow that they perform badly. If the investments are done prudently, there's proper governance, they could as well perform just like defined benefit pension schemes. There are also different types of administration models that are worth noting. We have what we call insured funds. Insured funds, these are generally very small employers, say with 5 employees, 10 employees. You could be an SME, you could be running your own farm, a small mine. You think you don't have time to spend monitoring your pensions, so you generally assign this responsibility to a life company. Then you tell them, can you manage our assets? Then they do everything. So these insured funds, they are insured in the sense that their assets are registered in the name of the insurer, and the members will just get a pension on retirement. There are no separate financial statements, actuarial valuation reports for these funds. The majority right now, about 700 something, close to 80% of the funds in Zimbabwe, they are insured. There are advantages and disadvantages of being insured, which I would not discuss possibly as part of, after my presentation, we can have a discussion in that regard. Then we have self-administered pension funds. These are generally large funds. They decide we are large enough to have assets registered in our funds. We can actually employ our own staff to do the administration. If they employ their own staff, it becomes a standalone pension fund, self-administered pension fund. If they outsource to a service provider, then that becomes a self-administered pension fund under an administrator. Independent administrators in the market include the likes of Comaton, Minerva, Bright, among others. These are companies that just specialize at administration of pension funds. Then the standalone, these are big funds, generally industrial schemes such as the mining industry. They would set up their own fund, the communication industry, the construction industry, clothing industry, or parastatals, because the very big employers traditionally, they would establish their own pension funds, CESA pension fund, GMB pension fund, NRSA pension fund, and we have about 14 of those in the market. Just to share statistics about the private occupational pensions industry in March 2022, as at 31 March, we had 977 registered funds, about 568 of which were active. By active, we mean they are actually receiving pension contributions, they are investing, and they also have some pensioners who are getting a pension. Then 409 are inactive. And what's the meaning of that? They are not receiving new contributions. And the reasons could be numerous. It's either the employer went under, they no longer have an employer, or possibly the employer has faced difficulties and can't contribute to a pension scheme which is voluntary for the private occupational pension arrangements. Only NASA is mandatory. The private ones, the employer can say, I no longer afford and I cannot contribute to a pension scheme. As I shared before, DB funds are about 41 and the DC are 936. In terms of membership, it's under 1 million. This is a reduction at its peak, at the peak of the economy in 96. It was almost 2-point-something million members contributing to pensions, to private pension arrangements. Now it's 552, including beneficiaries. In terms of assets, we are just finalizing our quarterly report. I hope by next week we'll be done and it will be available for public consumption. The assets are approximately 1.95 billion, about 2 trillion as of March. If you convert it official, that's close to about 2.1 billion. So that's the asset base. Allow me to move to players in the pension space, in the private occupational pension space, and their respective roles. One key player is a board of a fund. It used to be called the board of trustees before the enactment of the new act. The new act repealed the word trustee to make use of board. The board is the custodian of fund assets. Should you encounter misappropriation of funds of your pension scheme assets, the reason is the board, because they are the custodians, they are responsible for governance, they are responsible for ensuring that things are in place. They appoint all service providers. They can appoint an auditor, appoint an actuary, appoint an administrator, appoint an asset manager. All the service providers are appointed by the board. And that board, its composition is divided into two. You have employer representative members and employee representative members. These are nominated through a transparent process, and we are emphasizing on their skills to ensure that they are fit for purpose to oversee these millions of trust funds. They are responsible for financial reporting for the purpose of accounting to the members, as well as accounting to IPEC. Responsible for accountability to members through benefit statements, conduct of annual general meetings, where members are actually invited and being informed of the performance of the pension scheme. Then they appoint custodians, they appoint almost every key service provider. We have the fund members themselves. They are very key player. Most often the members think they don't have a role. They have a role in the sense that they have powers to appoint the members, the board members. If they are not happy, they can actually remove board members in office. They bring them to account. They should demand benefit statements, they demand financial statements, they demand conduct of an AGM. They are responsible for their own personal retirement planning. This is very important. In Zimbabwe, retirement planning is an aspect which requires consumer education. A lot of people think about retirement 2 years or a year before the retirement age. You are now 62, 63, you now think, okay, what's in my pot? Retirement planning starts the moment you start working. You need to know, as journalists, I would challenge you to say, do you know what's the name of your pension fund? Is it a DB? Is it a DC? What's the accumulation in your pot right now? How is it performing? Most of us, we are not seized with that until we get to retirement. So the members have a role to ensure that they plan for their own retirement. They can make a decision to do what we call voluntary contributions over and above what is being deducted on salary, and they've got rights to claim benefits, to avoid unclaimed benefits. A lot of people don't claim, especially should they migrate to diaspora. Some just have employment, they go to Kumusha, then they don't claim. Then we can experience what we call unclaimed benefits. So it's the role of a pension scheme member to ensure that they do claim their benefits. The sponsoring employer is another key stakeholder. The sponsoring employer is responsible for setting up the fund, negotiating with the members. They appoint employer representative members on the board. If it's a defined benefit scheme, they fund the actual deficit. They are responsible again for deducting member contributions not later than 2 weeks after end of a month. So that's an important stakeholder, the employer. The administrator, these are responsible for record keeping. Their biggest asset, I would think, is an ICT system, because they are essentially a secretary. They are a record keeper. They keep all records of the fund. They receive contributions and they pay benefits on behalf of the fund. Then, sorry for that. Asset managers, they are another key stakeholder. A fund can decide to do its own investment in-house. In that case, they would just need the experts. They don't outsource to anyone. Should they outsource, they outsource to asset managers. These are registered by the Securities and Exchange Commission. They are responsible for investment, performance of the fund, advisory, among others. So they are a very important role. So having assessed the respective roles of all these stakeholders, we ask ourselves as IPEC, are the pensioners happy? The answer generally is most pensioners are not happy. Okay, why are they not happy? There are various reasons. And we ask ourselves, what's missing? So the next section is going to discuss what we observe as improvement areas on each of those stakeholders that I discussed. The boards of funds, what we observe in general is that there's low quality of trustees. The trustees are appointed on the basis of activism in a workers' committee. They have very limited knowledge about insurance and pensions. So someone who makes the loudest noise in a workers' committee is being nominated to represent workers on the board of the fund. Some are actually conflicted. Generally, decisions are skewed towards the employer rather than the members. We are seeing things like a procedural recalling of trustees by workers' unions. They just recall a trustee for reasons that are not very clear. Then we are seeing abdication of responsibility to service providers, such as administrators. They are very powerful in the market, but they are just a secretary who has been mandated by a fund. So what are we doing as IPEC to address some of these mischiefs? We introduced some years ago what we call a certificate of proficiency as a minimum qualification. Basically, this has to be attained within 6 months. Someone should have basic knowledge about pension funds, governance, investments, and performance monitoring. We are upping the game. The regulations which are before the Attorney General's office right now are going to introduce the minimum qualification as a diploma. And some of the feedback that you are receiving from workers is that that's discriminatory, even in all level. But we believe this is a skills-intensive industry. A board is responsible for monitoring performance. They are responsible for financial analysis, responsible for governance, investment monitoring. These things cannot be easily understood should one not have minimum qualifications. So we are going to up the game once the regulations are out. We introduced the requirement for an expert trustee in the new act, where suppose a pension scheme member comprises, say, drivers only. Possibly this is a pension fund of a company which is into transport. They can now co-opt an expert trustee, mandatory requirement for an AGM and benefit statements every year so that the members see what's accumulating in their port, among other things. And we are also engaging labor unions, raising concerns regarding deficiencies we are observing on the board of a fund. The fund members, the weakness that we are noting is that they have no interest in monitoring performance, or possibly it's ignorance. The issue of retirement planning is on the low side, especially the need for retirement planning. Hence, we are calling for consumer education, and we believe even this exercise of mentoring journalists we believe it will go a long way in educating the members on the need for retirement planning. Then in terms of contribution areas, we are also noting that this is an area which requires a focus on. We are publishing in the newspapers areas. Those statistics are as of September, but as of next week, we would have updated statistics, including the underfunding of DB schemes. Regarding sponsoring employers, I have mentioned the mischief of non-remittance of contributions, and largely these are state-related entities which command over 70% of the arrears, poor communication with members, failure to fund underfunded DB schemes, use of fund assets, especially buildings, without paying rentals. It's important to note that 80% of every building you see in every city and town is owned by pension funds. And those buildings, they are owned by the funds, not the sponsoring employer. So the sponsoring employer is supposed to pay rent. But we are encountering instances where there's non-separation of the employer and the fund is losing through suboptimal rents or non-payment of rents by the sponsoring employer to the fund. So what strategy we are actually engaging those sponsoring employers that are not remitting. We're also naming and shaming in the press as a way of putting pressure. Then we are also requiring them to report these unremitted contributions to IPEC. Regarding use of buildings by employers without paying, the boards, we are actually mandating them to ensure that they protect the fund members. Regarding fund administrators, we noted the mischief of higher administration expenses, which are eating into the assets that would have been saved by the members. Poor record keeping, weak corporate governance. So what are we doing as IPEC? We've now introduced the regulation of expenses. We introduced expense limits in an effort to protect the fund members. We are enhancing risk and corporate governance, among other requirements. Asset managers. What we are noting right now, the traditional asset classes that were there since pre-independence, where pension assets are just invested in money market, bonds, properties, and equities. There's actually death of investment banking in Zimbabwe, innovation in terms of creation of new asset classes. Yes, some efforts of late, we see emergence of REITs. We see some new stock exchanges being set up, the likes of IPEC, among others, commodity exchanges being set up. These are new developments that we believe would help to ensure that there is diversity of investments. And of late, as IPEC, we now allow offshore investments up to 15% of balance sheet of a pension fund. So these are some of the initiatives that we are putting in place, including regulating the asset management fees, which we believe were corroding value in pension assets. So I would want to share some of the challenges that we are facing as an industry. The major challenge is loss of value due to inflation. We've had the first episode prior to 2008. We are in a second hyperinflationary era, which is not good for long-term savings. It has dented confidence in pensions. The issue of data integrity, this is an improvement area which you are working on with the industry to ensure that the management information systems in place are robust enough to keep records over a long period of time. We are seeing dwindling pension contributions that is attached to the issue of confidence and the developments in the labor market. So what are we doing strategically as IPEC? We are working on enhancing governance of pension funds. We are enhancing investment performance monitoring, including offshore investments. We are tracking benefits every quarter. We ask every pension fund to say how much have you paid to all your pensioners, the actual amounts. And we introduced what we call a bread index. By bread index, we simply say, okay, how much have you paid to pension X? They tell us the amount. Divide it by the price of bread. Then you can establish that a pensioner possibly can only buy 20 loaves of bread, 30 loaves of bread. Even if men shall not live on bread alone, we believe the bread index is a simplistic way of just determining the real value of the pensions that are being paid. We can talk of thousands nowadays, millions, but in real terms, we need to ascertain, and we're actually doing that and engaging with the respective funds. We are regulating expenses in an effort to protect the members. We are actually facilitating social dialogue on the need for holistic pension reforms, both public and private, engaging with employers, engaging with the labor unions and government, among others. We are also seized with the consolidation of small funds for economies of scale, issues to do with consumer education, and we believe as journalists, you do have a role of ensuring that we educate the populace on these aspects that we are sharing in this presentation. We are seized with ensuring record keeping. The new regulations that are before the Attorney General's office have robust provisions on record keeping. 2019 compensation and 2009 compensation. We have draft regulations which are now before the Attorney General's office. They are meant to implement the Justice Smith recommended compensation framework. Then regarding the 2019 compensation, this was in relation to the recent currency reforms. The industry is implementing a guidance paper on currency reform just to ensure that the assets are equitably shared. From the government side, they allocated an asset under Kuimba Mining House. First dividends were dispersed and to the targeted pension scheme members last year, about 400,000. We are being promised by Treasury that a significant amount will also be dispersed anytime soon, and it will also go towards augmenting benefits of vulnerable pensioners. We are enforcing expenses framework, enhancing risk-based supervision, engagement with labor organizations, instituting legal reforms, among others. In conclusion, I would say, notwithstanding the challenges that we are facing as an industry and as a country, the pensions industry remains strategic at an individual level and at a national level. A lot of people, as I discuss with stakeholders, say pensions is no longer relevant. Yeah, I don't think so, because at an individual level, everyone, it's certain that everyone is going to retire, and old age is as certain as death. And it's not possible for one to accumulate adequate savings for use at retirement. So the best vehicle is a pension scheme, and at a national level, there's no country that develops without a pension system. And the pensions is generally the largest source of domestic saving in any economy. So it remains a strategic source of capital for financial intermediation, for deployment into real sectors of the economy. We have noted, despite the challenges over the last 20 years, the industry has remained resilient despite the macroeconomic challenges. And the IPEC is committed to ensuring that we institute reforms that will unleash the potential of this sector. As journalists, we see your role in building resilience of this industry, building confidence, consumer education, and we believe you are such a key strategic partner. So as you even come up with articles, we believe articles that also build the industry, not just negative articles. Yes, as objective journalists, it will be a question of being factual, but we believe your role in building confidence is very critical. This brings me to the end of my presentation. Thank you very much for your kind attention.
Thank you very much, Mr. Mjoma, for a very detailed presentation, which was loaded with information. Just a few things whilst the next presenter is preparing to come in. A few issues that I picked from your presentation. You highlighted the importance of understanding the construct and purpose of pension funds so that when it comes to making demands or reporting on them, is from a contextual point of view. You also highlighted the differences between a defined benefit and the defined contribution, administration models such as insured pension funds, self-administered pension funds, and standalone pension funds. And in all this, I think, which is maybe homework to all of us, and particularly the media, the importance of educating people on retirement planning, that one needs to start early. You don't wait until it's 5 for you to start planning for your retirement. And then you also highlighted the responsibility of members of pension funds, that they do not just sit and leave the responsibility to the administrator, but that they should actively participate and interrogate management of their funds. And then as a way of closing, I appealed to the media to inform members of the public accordingly and to help in restoring confidence in the pension fund industry. That is what I picked from your presentation, sir. And we will take, I see people have been posting questions in the dialogue box. We will take questions after the next presentation, which is by Dr. Cosmas Chikwawa, who is the Research and Schemes Planning Manager at NASA. So Dr. Chikwawa, I'll ask you to kindly upload your presentation and then thereafter you proceed. Thank you. While it's loading, I think I'll just take one or two questions. Mr. Mjoma, there's a question on regulation. What are the advantages of the new act compared to the old?
Thank you very much. The old act was now archaic. It was a pre-independence act. Most of the provisions were now outdated. So broadly speaking, the new act aligns with the developments on the grounds, aligns with the international benchmarks for an effective pension supervision. Major improvements were in relation to governance of pension funds, starting from the board, the need for AGMs, the need for proper record keeping, the need for prudent investment decisions, accountability to members, among others. So it's actually a comprehensive review of what was in place. And we believe that piece of legislation will be a key pillar in restoring confidence in pensions. I submit. Thank you.
Thank you. And then the other issue, it was more of a comment but question. The bread index that you highlighted, the comment is bread index quite interesting. I think people are keen to know why bread and the effectiveness of indexing it against the price of bread.
Thank you very much. Good question. A lot of people are interested. You know, pensions is very technical. The moment you engage technical people, say actuaries, if they tell you about how this industry is performing, it will be very difficult to understand. You engage accountants after they do financial analysis, their ratios and everything else. They would tell you a language that you may not understand. So we sat down as a commission If you engage asset managers, they can actually speak in tongues as they try to convince you that they are doing wonders from an investment performance perspective. We said, let's think of a pensioner in Dotito or in some remote area in Zimbabwe. That pensioner is non-technical. Is not interested about the technical language, the actuarial issues, investment issues, accounting issues, economics, whatsoever. How they judge performance is simply through the purchasing power of their pension. So we said, okay, the purchasing power, how can you measure purchasing power? You can't also talk of poverty. That I'm lying to them, it's very complex. Or we can simply say, okay, how many loaves of bread can they buy? You say right now they are buying 20. If you have performed, we should actually see them buying 30 loaves or 40 loaves. If they see their value dwindling, possibly they're buying 50 loaves of bread, now they are buying 5 loaves of bread. They can actually tell that you are not performing. So it's a way of simplifying the seemingly technical industry to a layman level. Otherwise, you can use any indicator. This was a simplistic way of just measuring value. Thank you.
Thank you. And another question is, given the persistent exchange rate volatility in Zimbabwe and the devaluation of the local currency, how do you convince someone to invest in a pension scheme? What are the non-monetary pension options that IPEC can recommend?
Thank you very much. I believe the funds are doing prudent investment decisions. Right now, they are invested in 2 asset classes, largely invested in real assets, which are listed equities, as well as investment property. For some funds, they are even exposed to property to the tune of 70, 80%, of which is IPEC will actually worried to say, why can't you consider REITs which are divisible and for ease of liquidity, they can easily do so. So once an entity is invested in those real assets, I believe they are value preserving. There's also an option of going offshore, but most funds have not gone offshore because the return locally is also higher than the external markets. So I believe through the pooling of those resources, economies of scale can still be achieved, value preservation can still be achieved, return for investments can still be achieved. We've also noted an increase in investments in alternative assets. These are investments in renewable energy, solar plants. A number of solar plants have been commissioned by the president. They are feeding into the national grid. There are also investments in agriculture, which we believe is also creating good value. So I believe in as much as we are facing macroeconomic challenges, I do not believe they are perpetual, and I believe pensions remain relevant. I submit. Thank you.
Thank you very much, Mr. Munjoma. And I think we are ready now to move to the next presenter. Mr. Chikwawa, I see his presentation is on the screen. And as soon as you are ready, say if you can. Yeah.
Okay, good morning, ladies and gentlemen. Sorry for the delays due to the technical problems that we had, but we are now ready to go. As you've been told, my name is Cosmas Chikwawa, the Research and Schemes Planning Manager for NASA. My presentation is on the pension and other benefits scheme, but I'll give a brief overview of NASA's mandate so that we contextualize the pension and other benefits scheme. Now for the outline of the presentation, I'll talk of the mandate of NSSA. And in speaking about the mandate in elaborating, I'll also talk of ILO guidelines on social security standards, because they guide us in designing our social security schemes. And I'll then talk of the pension and other benefit scheme in terms of its mandate and model. I also talk of the position of the pension and other benefit scheme within the national pension system of Zimbabwe. I'll also share some facts and figures in terms of contributions as well as benefits being paid under the pension and other benefit scheme. I'll talk of our main strategic focus areas as well as risks and challenges facing the scheme and key initiatives that we have embarked on to mitigate the challenges and risks. Now for the NSSA mandate. NSSA's main mandate is to develop and administer social security schemes in Zimbabwe, and also to advise the parent minister, that's the Minister of Public Service, Labor and Social Welfare, on all matters relating to social security in general. NSSA is established in terms of the NSSA Act, or the National Social Security Authority Act, Chapter 17.04 of 1989. And it's currently running 2 social security schemes. That is the pension and other benefits scheme, which is the main subject of discussion today, as well as the accident prevention and workers' compensation scheme. Each scheme is governed by its own statutory instrument. The pension and other benefits scheme is governed in terms of statutory instrument 93 of 1993, while the accident prevention and workers' compensation scheme is administered and governed in terms of statutory instrument 68 of 1990. In addition to these 2 schemes that we are running, NSSA also has the mandate of administering the Factories and Works Act, as well as the Pneumoconiosis Act, which have something to do with safety and health at the workplace. So through these acts, NSSA promotes and enforces safety and health standards in workplaces. So in the design of our schemes, we are guided by ILO standards. ILO is the standard bearer in the realm of social security. In particular, there is ILO Convention 102 of 1952, which is known popularly as the Minimum Standards Convention, because it stipulates the minimum standards for social security provision. The minimum standards are encapsulated as 9 contingencies of social security, or 9 branches of social security, which are old age, survivor, invalidity, employment injury, healthcare, sickness, unemployment, family benefit, and maternity. Of these 9, NSSA is already covering 4, that is old age, survivor, invalidity, and unemployment. The 5, employment injury or work injury. The 5 that are still to be covered are highlighted in red font there. They are healthcare, sickness, unemployment, family benefit, and maternity. So you can see that we still have a way to go in terms of meeting the minimum standards stipulated by the ILO. However, we have made notable steps in terms of the scope of social security contingencies that we are covering. Right, I think we can now zoom in on the pension and other benefit scheme, which is normally abbreviated as POBS, which is a mandatory contributory social security scheme for workers in the formal economy between the ages of 16 and 65. That's the defined group that contributes to that scheme. Employers contribute 50% of the contribution, that is 4.5% of the contribution, while the worker also contributes the same amount at the same rate, 4.5% of contributions. Up of earnings up to a set insurable earning ceiling, which is reviewed regularly. Now for the benefits that are realized under that scheme, the POB scheme, we have retirement benefit, which is normally paid as a pension where the contributions have been made for at least 10 years. Then the benefit is paid as a pension. Where the contributions have been made for at least a year, but for less than 10 years, then it's paid as a retirement grant. So in terms of qualification, I'll elaborate later, but in terms of qualification for that benefit, the normal retirement age is 60 years of age, but one may elect to retire later up to the age of, but they cannot go beyond the age of 65. So that's the normal retirement age 60, late retirement going up to 65. Then we also have the retirement age of 55 for those who are in arduous occupations or physically strenuous occupations, like, for example, in mining, underground operations, in forestry, and so forth and so forth. Those ones can retire at 55 and get their retirement benefit, those in arduous or physically challenging occupations. Then we have the invalidity pension. That's for people who become permanent contributors who become permanently incapacitated due to illness or injury. They get the invalidity pension. For one to qualify, they must be below retirement age. Otherwise, if they've reached the retirement age, their needs will be addressed through the retirement benefit. Then we have survivor's pension or spouse pension, which is paid out to the spouse of a contributor in the event of their death. Along with the spouse pension, we also have children's allowance, which is paid to surviving children of a contributor. Then we also have funeral grant, which is paid out to help in meeting the funeral expenses of a contributor in the event of their death. So in brief, those are the benefits under the pension and other benefit scheme. I will elaborate more in terms of the qualification criteria eligibility requirements, I think I've highlighted, yeah, most of those criteria there. Basically, that contribute for a pension, a retirement pension for one to qualify for a retirement pension, they should have contributed for at least 10 years. And for one to qualify for a retirement grant, they should have contributed for at least 1 year, but for less than 10 years. Then for the invalidity benefits or benefits, one is to have contributed for at least 1 year to get the pension, the invalidity pension. The survivor's benefits, there must have been a contribution for at least 10 years for the survivor to get the survivor's pension. Then the dependents allowances, these are paid to children of a deceased contributor. Right, let's look at the current benefit levels. We review our benefits regularly to make sure that we are not out of step with economic trends. Currently, the retirement benefit, the retirement pension is 55,715 and 46 cents. That's the minimum retirement pension. It can be more than that, but the minimum is 55,715, 46 cents. The minimum survivor's pension is 22,286 and 18 cents. Then we have the minimum invalidity pension is exactly the same as the minimum survivor's pension, 22,686, 18 cents. Then the funeral grant is currently pegged at 48,000 Zimbabwe dollars. And of course, our target is to pay a minimum pension that is equal to at least to the world poverty datum line of $2 US per day. Financing, let's look at financing mechanisms for the scheme. As I've already mentioned, the scheme is mandatory, sustained or funded by mandatory contributions by employers and employees within the defined demographic cohort that I described. There is an insurable earning ceiling, which is calculated at 3.5 times of the total consumption poverty line. So the scheme is, it follows a scaled premium method, which allows for adjustments as the scheme grows. As you can see there, the graph there shows that there have been adjustments in terms of the contribution rates over the years. Between October 1994 and May 2013, the contribution rate was 6%. It moved up to 7%, and it was at 7% between June 2013 and May 2020. It later moved up to 9% between June 2020 and the present. So it's currently at 9%, 5% by employee and 5% by the employer. Right, our model is a partially funded pay-as-you-go system, which combines elements of both a funded and a non-funded system. where the contributions that are currently being made at the moment will help also to fund the current beneficiaries, the current benefits, and so forth. So there is generational, intergenerational dependence in that system. Now let's look at the position of NSSA within the national social protection system. In Zimbabwe, the national social insurance system comprises of NSSA, the Public Service Commission pension, and private pension schemes that are regulated by IPEC. NSSA is designed to complement other pension systems. That's why you realize that the contribution rates are quite low in comparison with those of occupational pensions and private pension systems. It is the design is designed is that way to ensure that the contributors will remain with enough to contribute to other social security schemes of their choice, as well as to occupational schemes. I think it needs to be understood that NSSA is meant to complement and to be complemented by other social insurance systems. So the benefits that we pay should also be viewed in that context, where they are meant to complement other benefits from other insurance systems. We are now looking at some facts and figures there in terms of our membership. We have a total of 36,307 employer organizations that are contributing. We have employees that are actively contributing at the moment. They are about 1.3 million, while those who are inactive are about 1.8 million. The POB scheme covers approximately about 35% of the labor force. Oh, sorry. I think I moved. Yeah, so those are the figures in terms of contributions. In terms of benefits, we also have some facts and figures as well to share. The retirement benefits. Currently, we have 102,464 recipients of retirement pension and 89,716 recipients of survivor's pension, as well as 18,087 recipients of children's allowance. We have 2,384 recipients of invalidity pension, and we also have 339 recipients of dependence allowances, who are usually the parents of contributors. Usually the parents get the dependence allowance where the contributor was not married and did not have children. The pension dependence ratio is currently at 1 contributor to 66 beneficiaries, to 6.6, sorry, beneficiaries. However, it is projected that this ratio will deteriorate to one contributor to 2.72 beneficiaries in 50 years to come due to increased longevity and decline in fertility. You see, globally, we now have the problem called the aging problem, where people are living long. Of course, it's desirable, but when you look at it from the standpoint of a pension system, it can actually be strenuous to a pension system, especially when you look at the contribution period versus the prolonged life, where one will be just receiving the benefits when they have since ceased making contributions. So it's a global challenge, which can also affect us, but as a developing country, we are in a better position in comparison to developed countries which are seriously facing the aging problem. We have some more facts and figures in terms of new registrations, which I think post-COVID-19 are on the increase. As you can see there, new registrations. In 2022, there were 16,508. Active employers at year end, they were also increasing post-COVID, which is also a desirable phenomenon there. Death benefits processed also increasing gradually there, so there is a balance there. We also have new pensioners increasing gradually as well. We also have short-term benefits being processed, also on the increase post the COVID-19 pandemic. Now let's look at our strategic focus. Our main focus is to ensure that our schemes are financially sustainable. We also are interested in making sure that we extend coverage in terms of, in other words, we expand in terms of the benefits that are offered, the scope of the contingencies. We also need to increase the benefits levels, as well as to increase the numbers benefiting or the demographic cohorts covered by the scheme. So scheme sustainability, we are targeting increasing the number of individuals covered, as well as also improving the investment so that the scheme becomes more sustainable. We are also looking at improving service delivery. And in this regard, we are looking at riding on our ICT system for more efficient services, especially the use of self-service platforms, like self-service portals. In this regard, they'll be quite useful. We're also looking, of course, at benefit adequacy. And in this regard, we will continue to innovate and come up with new ideas to increase the benefit levels or to augment the current statutory benefits with the even non-monetary benefits and other benefits that can complement the statutory benefits and build resilience among our pensioners. We're also looking at improving our management system, ensuring that we effectively deal with the error, evasion, and fraud to safeguard our social security resources, and by making sure that they go to deserving beneficiaries. Our challenges, I think some of them I've already mentioned in the presentation. But our major challenge is exclusion. I think you appreciate that currently our social security schemes are formal employment based, and that way they exclude those who are in the informal economy, who happen to be the majority, actually, ironically, because according to labor force surveys that have been done by Zimstat, they've, over a period of years, indicated that the informal sector is constituting the greater percentage of the labor force vis-a-vis the formal sector. So we have that challenge of exclusion. We have that challenge of an uncovered informal sector, which has been growing. Yeah, and at times it grows. It's ups and downs, but it's still quite huge. And in that sense, as long as it is uncovered, it poses a huge challenge to us as the provider of social security. So to address this challenge, we are working on a scheme for the informal sector, a scheme that is tailored to meet the needs, the specific needs of that sector, taking into account its peculiarities. The other challenge is depressed performance in capital markets, impacting on returns generated from investments. We are trying to address that through diversification, through increasing investment in alternative areas and private equities. The other challenge is that the NSSA insurance pension, I think I've highlighted that it's perceived as the pension fund that contributors should rely on for their sustenance post-retirement. But by design, it's not the only pension, as I've explained. It's actually evident in the contribution rates and the insurable earning ceiling that by design, it's not supposed to be the pension or the only source of sustenance for a retiree. So that's a challenge. It's a perception out there, which maybe as journalists you could help us by maybe communicating maybe more accurately in terms of the role of NSSA within the scheme of things, the role of NSSA within the overall social protection system. It will help to make the public understand that NSSA is not meant to be the only social security, the only pension system or scheme. It's by design something that is meant to complement and to be complemented by other pension systems. Of course, we won't rest on our laurels saying we are not the only pension, so we can relax. No, we will try by all means to make sure that we give meaningful benefits. And in this regard, we are actually we've actually taken some comprehensive measures to augment benefits. We've introduced non-monetary benefits and so forth. We continue to engage our stakeholders so that we get as many ideas as we can to improve our system. Then the other challenge is about the huge volume of social security data, which at times is incomplete and inaccurate, militating against the effective delivery of services. But to address this challenge, we have been very deliberate in addressing this challenge. We have established a data management unit within the authority to ensure that data is properly managed and we have accurate and reliable data, which makes sure that we dispense our mandate more effectively. We also have external risks that can impact on our service delivery. For example, the COVID-19, although it appears to be relenting, I don't think it has completely left us. So those are the challenges that we are dealing with, but we are putting in place measures to adequately address them. Right. Let me elaborate a bit on the initiatives, some of which I've already mentioned, but we have put in place some well thought out initiatives to improve benefits. We have introduced a plethora of non-monetary benefits to augment statutory benefits and build resilience among our pensioners. For example, we have introduced a revolving loan facility for NASA pensioners to finance their self-help or self-sustenance projects, which we are working on this project through a number of banks which are dispensing the loans. We are also working on a knowledge transfer goat rearing model for pensioners, again in an effort to build resilience and economically empower our pensioners so that they'll be able to generate income to augment their pensions, their statutory pensions that they receive from us. We have also introduced a discount facility, a grocery discount, a discount facility for groceries as well as drugs through partnerships with selected supermarkets and pharmacies. We have also introduced a bank charge exemption for our pensioners so that they don't lose much in terms of their transactions. It helps to make sure that they remain with something substantial as they access their pensions. We are also making interventions with regard to healthcare for our pensioners. We have a mobile clinic, as well as some clinics. We have set up some clinics as well to make sure that we help our pensioners with basic health care. Those interventions ultimately will actually help to make sure that their pensions won't be spent on medical costs and so forth. So at the end of the day, the pensioners will remain with something substantial through those non-monetary interventions. We are also having regular stakeholder engagements, in particular with our key stakeholders, the pensioners. We have realized that that is a key component of good corporate governance, which ensures that there is accountability, there is exchange of ideas, there is feedback from our pensioners, which helps us to improve our service delivery. We have held engagements with our pensioners countrywide. For example, I think you can see there on the slide, we've been in Mutare we've been Chipinge, Rusape, Chinoi, Kadoma, Gweru, and so forth and so forth. So these engagements, they help to create a platform for feedback that will help us to improve and fine-tune our service delivery so that ultimately we will realize excellence in service delivery. Then, of course, maybe we'll talk a little bit about data management, which I've mentioned. We have established a data management department, and it's improving. The quality of data is gradually improving. Our major challenge, one of our major challenges, as you can see from that slide, is bridging the coverage gap, both in terms of the contingencies covered. As I've already said, we are covering 4 out of the 9 stipulated branches, as well as in terms of the coverage of demographic cohorts. As I've already mentioned, for example, the informal sector is not covered when it's constituting the bigger segment of the labor force. So, of course, we are addressing that through coverage extension. Coverage of extension of social security to the informal sector is quite key. And it's actually in tandem with our national vision 2030, as well as sustainable development goal number 1 of ending poverty in all forms everywhere. So we believe social security is a key tool in achieving our national vision, as well as in achieving sustainable development goals, especially goal number 1 on poverty reduction. So we are, as I've already mentioned, we are covering about 35% of the labor force with our formal scheme. And we are making frantic efforts to extend social security to the informal sector. In this regard, we are also complementing government efforts to formalize the informal sector. Government has put in place a deliberate program and a strategy for formalizing the informal economy. So somehow we'll meet somewhere. There's formalization of the informal economy. There is also development of a specific scheme for the informal, for workers in the informal economy. That's in line with the ILO recommendation 204 of 2015 on transitioning from formal to informal, which is meant to ultimately to promote decent work and to promote safety and social security for workers in the informal economy. So in terms of extension of coverage to the informal sector, we have made some strides, although we still have some way to go. We have undertaken a feasibility study through the assistance of an ILO expert. So a feasibility study has been done, and the study concluded that it is feasible to extend social security to the informal economy. We have also done some benchmark engagements with other countries within the region on the issue of social security extension. And from these benchmark studies, it has been highlighted that we need also to include some short-term benefits in our scheme design, since people normally are gratified, are maybe interested in instant gratification. So we need to blend our long-term benefits and short-term benefits as well. We have also engaged the Zimbabwe Chamber of Informal Economy to gain deeper insights into the needs of the various associations within the informal sector, the various subsectors within the informal sector, and they've provided us a database which will help us as we develop the scheme for the informal sector. The next step is to undertake a needs assessment survey for the informal sector. This survey was also recommended by the feasibility study that was undertaken by an ILO expert. It recommended a comprehensive needs assessment survey to determine the exact social security needs of the sector, the priorities of the sector in terms of social security, and to have a deeper understanding even of the demographic structure and the heterogeneity of that sector. In this regard, we are also reaching out through our ministry to the ILO and various other development partners for support to kickstart the scheme. Well, since it's a new scheme, it means it does not have contributors as yet. So we need some financial support as well as technical support to develop this scheme. Finally, our desired outcomes, what we desire is to ultimately achieve universality of social protection or social security. In other words, we want to leave no one behind in terms of social security provision. Ultimately, we want to cover all demographic cohorts to make sure that nobody is devoid of social security coverage, since social security is a human right. Then the other focus, the other outcome that we aspire to attain is adequacy of benefits, both in terms of the coverage, the scope of contingencies. We want them to be adequate. We want to cover all the 9 ultimately. We also want to achieve adequacy in terms of the quantum of the benefits that we pay out as well. And also we need to realize portability of benefits across national borders. We need to make sure that social security rights and benefits are portable across national borders. We are living in a world which is increasingly being globalized, and it's characterized by movement from one country to another. So portability is a key issue that we hope to attain. And of course, we need to work with other countries, do some bilateral and multilateral agreements to facilitate portability. But it is indeed a key and topical issue in on the social security agora. And finally, we also aspire to improve our corporate governance system, since everything hinges on corporate governance. To be able to realize excellence in social security provision, we need to make sure that we are adhering to good corporate governance principles, thereby positioning ourselves in good stead to effectively dispense our mandate. I thank you. That ends my presentation.
Thank you very much, Chipawa, and yet another rich presentation full of content. And colleagues, both presentations will be shared so that you can go through them and extract as much information as you want. We are now going into questions, and before we do that, there's just one minor corrections on one of the slides, which is currently on the screen now. The minimum invalidity pension is 70,000. The minimum invalidity pension for those people who get injured at work, the minimum invalidity pension is 70,000. Well, thank you very much. And now we go to the questions. And whilst you are still there, I'll start with the questions that have been put in the chat box. If the NASA contribution eligibility is at least 10 years, what's the advantage of someone contributing for, say, 20 to 25 years compared to one who contributed 10 years? I think I'll just read 3 questions and then you can respond to them. So, and then, what do you mean by inactive employees? Inactive employees. So those are the 2 questions for NASA, and then I'll move on to one for IPEC.
Yeah, I've unmuted. Yes, let me start with the question on the advantage of contributing for more than 10 years. If you listened well, I said 10 years is the minimum qualification period for one to be able to receive a pension benefit. But it's not advantageous to contribute for only 10 years, because when the benefit is calculated, when the amount that you get per month is calculated, it factors in the period of contribution. So the one who contributes for more than 10 years, if they're contributing maybe at the same level with the one who contributed for only 10 years, they would then stand to get more. They don't get the same pension amount. The pension amount that I gave is the minimum. It's not the maximum. There is room for earning more than that, depending on how long one contributed and other factors, even the contribution level. So really, it's not an advantage. In fact, it's a serious disadvantage if you contribute just to be able to get the barest minimum. Thank you. Oh, okay. Thank you. Let me go on to the next question. Inactive employees are employees who at some point were registered with NASA, but are not currently contributing. That's why we always distinguish between active and inactive. Active are those who are currently, active employees are those who are currently contributing. Inactive are those who contributed for some time, but are currently not contributing. Thank you.
Right, I hope Mr. Munjoma is still there. There's a question for IPEC and there'll be more questions coming in. IPEC, why not look into private pension schemes and come up with a baseline, especially in this era where, for example, Harare City Council pays 13,000 as a pension of former or late employees? In this era where money is being eroded, why not set a baseline?
Thank you very much, Shingrai, for the question. We have what we call a minimum pension for the purpose of informing a preservation amount. By minimum pension for the principal pensioners, the actual former employee, say of City of Harare, the minimum according to what we prescribed should be at least $40 per month, equivalent of 40 USD. For the beneficiary, it has to be at least 20 USD equivalent. Anyone who is earning less than that, they can qualify to commute the full amount. That is getting the full balance as a once-off payment. But before we allow them to commute, what we insist on is to ensure that their pension increases in line with the investment performance. If that amount, say, of 13,000 is really in line with investment performance and there are no prospects of enhancing it, which I would doubt very much, then they can commute. But what we are observing is that we still have a significant number of pensioners earning below the minimum amounts that we have. And as the position that we took as IPEC is, we need to address legacy issues. Legacy issues to do with the pre-2009 compensation as well as 2019 compensation. Why? If you ask someone to commit, you are simply saying, okay, you are getting 13,000, now I'll give you, say, 150,000 or 200,000. Then you are paid off, which still may not meet the reasonable expectation. So as a regulator, you want to establish why are they paying 13,000? We don't have enough history, whether the person has worked for 30 years or possibly just worked a few years. but we need to be satisfied. Why is it 13? What are the factors? Are there implications of loss of value for 2019? Are there any implications for 2009? Then there's a program which is meant to ensure that these people are compensated. The regulations, we understand they are now at the gazetting level stage. There is a contribution from the fund itself, a contribution from government, and IPEC is also going to contribute something such that these benefits are enhanced. After resolution of those legacy loss of value, then they may commute the value. So should there be concerns of this nature, what we normally do, if someone can actually approach us to say, I'm not happy with the amount that I'm getting from such a fund, these are the circumstances I contributed so many years, and this was what I was earning. We normally intervene and try to explore. Otherwise, on the face of it, you can't tell whether that person is a dependent or is a principal member. How many were they? Possibly there were a lot of dependents that were sharing the same amount. Circumstances on the face of it won't be clear. But yeah, there is a minimum pension for the purpose of preservation of 40 USD equivalent, 20 USD for the beneficiary. And anyone who is earning a pension which does not make any economic sense has an option to commit it. I submit. Thank you.
Thank you very much, sir. We now open questions to the floor. If you can indicate by raising your hand so that we can give you the floor. I see a raised hand there. Unfortunately, I can't pick who it is. I think you can go ahead.
Thank you so much. I just have 2 questions. The first one is, how many people are targeted under the initiatives that you're talking about to increase benefits with regards to the goat rearing project? And also, what is it that we need to be part of the initiative, and what investments should they individual?
Sorry, Rumbizai. Could I ask you to repeat, to start again, please? There's so much background where you are. We can hardly get the questions.
Okay, can you hear me now? Hello? Okay. The first issue that I had was to do with the initiatives to improve benefits. So under that, I wanted to find out for the goat rearing projects that you're talking about, how many people are targeted under this initiative? And then also, what is it that the pensioners need to be part of the scheme, and what investments should an individual be looking at?
Okay, and the next question. I thought you said you had 2 questions. Okay, all right. I think we can respond to that. Yes.
Okay. The GOT project is initially targeted at, I may not remember offhand, but it's a small number of people to start with, but we'll scale it up. Actually, we are starting it as a pilot in Bindura and Gwanda. Then in the process of time, we will scale it up so that it will cover more people. But we are starting with small numbers initially as a pilot, on a pilot basis. Thank you.
Were you answered, Rumbizai?
The second part, in terms of investment, what are the individuals looking at investing for the goat rearing project?
The individuals are required just to be organized, and because it's a group-based scheme where NASA will provide the seed in terms of the back, and then from there, the back is expected to mate with the goats that are available, and thereafter NASA will also provide technical expertise and will also provide with the facilities where the projects will be undertaken. So really for the pensioners is for them to be available, for them to be organized so that they can participate in this project.
All right, thank you.
Any other questions, please, colleagues, if you can raise your hand or just quiet because I'm not seeing any hands here. Do we have any questions? Tulani, you can go ahead. Tulani, please unmute yourself and ask the question. Tulani, if you can hear me, please unmute your mic and ask the question. I think Tulani is having technical issues. Do we have any other question whilst he's sorting out his network problems? Or Tulani, alternatively, you can write your question down because we cannot hear you, and your mic is muted as well. You can go ahead now. Tulani.
Hello? Yes, sorry about that. My question is directed to Director Munjoma. He talked of naming and shaming those sponsoring employers who use pension schemes, buildings, and maybe do not pay rent in those buildings. Have you seen that to work, maybe taking, looking at those companies that you've named and shamed before, if there are any?
Thank you, Tulani. The naming and shaming was in relation to contribution areas. It's actually illegal to collect, to deduct pension contributions, and they are not remitted. The new act, which came into force on the 2nd of September 2022, actually places the criminal liability on those that would have done so. But what we've been doing is we need to inform the members themselves that their own employer is making paper deductions but not remitting the same to the pension fund, because the implication of that is someone can get to retirement and you are told there's nothing in your pot. The reason that for the past 20 years the employer has not been remitting pension contributions. So we've seen it working. A lot of it actually exerts a lot of pressure on the employer, from labor, from government, from the regulators, the parent ministries, if they are parastatals. And we've seen an improvement. Some are now entering into some data asset swaps. Some do have land, they would sit to the pension fund, and they are entering into agreements. So we are seeing it working, and we believe going forward, the arrears would actually be declining. I submit. Thank you.
Sorry, just a follow-up, say, can we then say maybe Tulani has been working and contributing for 25 years and he's retired, and then all of a sudden he realizes that his former employer was not remitting those contributions. What then happens? Is it a lost cause? to Tulani, or is there any way of maybe remedying that?
In the regular, in fact, there are a number of measures that we've put in place. We insist now on a disclosure. It's a requirement that Tulani by year end, Tulani should get a benefit statement. The benefit statement should clearly indicate that Tulani, your only contribution as an employee towards your fund is this much in 2023. The employer brought in this much. The investment return on those contributions is this much. And your pot now has this much. So if it's a DC pension scheme, which the majority are, it's like a bank account. Anytime you should know how much is in your bank account. So you don't have to wait to go and withdraw to know. You already know what is there. So the same applies even for pensions. You don't need to get to 65 to know what is in your pot. Today, right now, you should know to learn. You should actually know how much is in your pot if you are contributing to a pension scheme. If you don't know that, that's a weakness on your part in terms of retirement planning, a weakness on the part of the board of the fund, and that amounts to non-compliance with the legal requirements in terms of the Pension Provident Funds Act. So you need to know the employer has to do what they're supposed to do. Then as a regulator, as a last resort, we've now been given powers to garnish the bank account of the employer in favor of the fund. So again, we can use that, but as a last resort, otherwise we should expect a functional system where if contributions are deducted, then they are remitted. So suppose it has happened, which has been the case, where certain funds have not remitted since as way back as 2000. In the absence of a policyholder protection fund, tough luck, because you are getting to retirement, there's nothing in your pot, you are getting into poverty. If you were not on NASA, then there's no fallback. Otherwise, it will be more of social assistance from government. So to manage such a situation, the new law, the Pension Provident Funds Act and the IPEC Act have introduced what we call a policyholders and pension scheme protection scheme, such that should there be such instances where one is exposed, they may benefit from such a scheme. Otherwise, prior to the recent legislative developments, there was no recourse. If there's no NASA, tough luck. If there's no social assistance from government, tough luck. And we've put in place measures to ensure that pensioners are not exposed.
Thank you.
Thank you.
Well answered.
Thank you, sir. I don't see any other questions, so I think we can safely move to the next item on the agenda, which is the exciting bit. First session reading presentation by Tinashe Nyaungwe. IPEC. Tinashe, over to you.
I have a question.
Hello?
Yes, I'm saying I have a question.
Someone saying they've got a question?
Yes, I have a question.
Chingrai.
Yes. Okay. I would want to highlight on the issue of market conduct and regulation. This is specifically to IPEC. The protection of members and policyholders, the issue of medical fragility, the healthy side of it, policyholders, medical aids and staff, those who are contributing in RTGS seem not to be protected, unlike those with the what is IPEC doing? Because in terms of
okay, I think the question is
using you're most probably using market rate, and while they are using the parallel market rate, they are not treating it similar with those using the USD rate. What is IPEC doing in protection of these health policy holders? Thank you.
Thank you, Singrai. You were breaking, but I think I got the gist of your question, where essentially you are saying pensioners are exposed because of the medical aid schemes, those differential treatment of those on USD vis-a-vis those on Zim dollar. That's the gist of what I got, though you were breaking. Confirm that's the gist of your question?
Yes, that is.
Okay. I wish to acknowledge that medical aid schemes are not regulated by IPEC. They are not prudentially supervised. They are not supervised from a market conduct perspective. They are registered by the Ministry of Health, and the Association of Healthcare Funders has a role in that respect. But they are not prudentially supervised and even supervised from a market conduct perspective from the way we understand. So this is an area of concern as part of our policy advice to government. We believe pensioners are exposed. The model for health, post-retirement health support in Zimbabwe is not ideal for pensioners because it's premised on the assumption that I'll continue paying for medical aid when I'm now retired. When you are retired, you're vulnerable, and that's the time when you need health support the most. You know, a lot of diseases, BP, arthritis, among others. So the current model, I don't think it's conducive and it's appropriate because it's premised on continued payment. So we need as a country to come up with a model which is more long-term, where one contributes now, on retirement you enjoy the benefits. So the issue of the National Health Insurance Scheme, which is being championed by the Ministry of Health and being envisaged to be one of the pillars under NSSA, I believe it will go a long way in addressing these needs. All I can emphasize is the need for a consultative approach. We understand there are developments taking place, but as an industry, are not involved. We believe, should we get on to the discussion table, we can also share some insights which will help in ensuring that the current gap that we are observing is going to be closed. Otherwise, colleagues from NSSA may also comment. They may have insights, especially regarding the developments surrounding the National Health Insurance Scheme. I'm not sure, colleagues, I'm putting you on the spotlight. But I take note of your concerns. It's a shared concern, and certainly there's need to close that gap. Thank you.
Yes, thank you, Mr. Mjoma. I don't think we've got anything to add because it's something that is being spearheaded by the Ministry of Health, and yeah, they do consult us as NSSA in terms of for technical input, but it is entirely a Ministry of Health project. Thank you. Right, colleagues, I think let's move on to the next item on the agenda. If you have any further questions, by all means, you can free to contact us by email, by WhatsApp, or whatever your preferred mode is. But Tinashe, over to you for the winning articles presentation. Thank you.
Thank you, moderator, and good morning to everyone. Kindly confirm you can hear me and you can see my presentation.
We can hear you and see your presentation.
Thank you so much. So in this segment, I'll start by saying that we had the first session, which was held in March. And from that session, we had a total of 63 articles. Most of them were very good. And now we are here to award the best ones. So for these awards, we have 3 categories, and the administrators of this program award the best 2 categories, best 2 articles per category. That is the winner and the runner-up. So to the journalists, you will find that the articles that won for this round were those considered to be well-researched, outsourced, and were not a repeat of what was presented or a repeat of what was taken from a report or a speech. articles that were considered to be creating awareness around the subject matter picked, and articles that were educative and informative. This was mentioned, I think, earlier when we started, when we launched the program. So I will not dwell much on those. I think we all know what we were looking for. So the first category is the electronic media category, where we have our runner-up, who is going to get 150 USD or equivalent at the prevailing bank rate. So for that, our runner-up is none other than Tanaka Makwaza from Diamond FM. He walks away with 150 USD or equivalent and a certificate that will come your way. The winner for this category now, the electronic media category, we have Kenias Chivuje from ZBC News. He walks away with 200 USD or equivalent at the prevailing bank rate. So a certificate will come your way, and also the money will be coming your way very soon. So the next category, we have the digital media category, where we have our runner-up, who is Tendai Makaripe from zimsin.com, and also the article which is highlighted on that presentation. He walks away with 150 USD or equivalent and a certificate. Our winner, excuse me, ladies and gentlemen, for this category is Eddie Makwaza from the Observer Zim, and the article is there. He walks away with a certificate and also 200 USD equivalent. Well done to you, and well done to everyone who's won so far. Without wasting time, we also move on to the print media category, where we have our runner-up, who is Prosper Ndlovu from the Chronicle, and the article is there. So well done to you, and 200 150 USD is coming your way, and your certificate. The winner, last one, the winner is Tendai Gukutikwa from Manika Post for her article, Vendors and Pension Scheme on the Cards. So well done to you, our winners, for this session, and thank you for submitting your articles. Thank you very much. That is the end of the awards. And I'll just mention here that we have other journalists that we have not seen their works from. And we still wait for those. And might I mention that the administrators reserve the right to drop those who are not producing articles as highlighted in the contracts that were sent to you, the journalists. So thank you very much. Moderator, I give back to you the time.
Thank you very much, Tinashe, and you are very, very polite. You were very polite with your last statement about the need for people to contribute. I think it's quite clear, and it's been communicated that people are expected to submit articles or to submit their recordings on after each session, and those who fail to do so will be dropped out. I think it's only fair because we selected people and left out others, so participation is expected. Thank you very much, Tinashe, and I now hand over to Lloyd Gumbo for closing remarks, and after which we will adjourn this session. Thank you.
Thank you very much, Tendai, and thank you, Tinashe, for the presentation. I would like to say on behalf of the Insurance and Pensions Commission, IPEC, and the National Social Security Authority, NSSA, who are the organizers of the Journalist Mentorship Program, I would like to express my heartfelt gratitude to all of you for your active participation from the first session and now in the second session. We really appreciate your active participation and the output of your work from the sessions that we are conducting. I would like to thank our presenters today, Mr. Cuthbert Njoma, the Director of Pension Supervision at IPEC, and Dr. Cosmas Chikwawawa, Research and Schemes Planning Manager at NASA under the Pension and Other Benefits Scheme. Lastly, I want to say thank you to all the participants on the program, those who managed to join in. Our apologies for those we had issues with the network earlier, who were struggling to connect. We hope that you won't be having any such challenges in the future, and also to advise that we are going to be sharing the presentations that have been done. We'll also share the video recording, the link for you to be able, particularly for those in the electronic media who may want to utilize the footage or the recording. We will be sharing these with you today. And to the Secretariat, those who are running with JMP, thank you very much for your efforts and for your commitment to ensure that we always make it a point that we have these sessions and putting everything in place for us to be able to conduct these sessions. And last but not least, to the moderator, Tendai, thank you very much for steering the ship. We really appreciate the work that you did throughout this session. And thank you very much to all the participants. Over to you, Director of Ceremonies.
Thanks, Lloyd. I asked you to close. I think we've come to the end. We have come to the end of our session, and thanks very much, everyone, for participating. We look forward to articles. We look forward to meeting again in the next session. We're now closing the meeting. Thank you.
Thank you and goodbye.